Hi, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage, and today I wanted to do a quick presentation on how a no-cost refinance works and answer some of the most common questions. Okay, so essentially a refinance does have closing costs. So when we say a no closing cost refinance, we're specifying that you're getting a credit that would cover the closing cost in general, so that you actually do not have any closing costs that you have to pay out of pocket or are rolled into the loan. So you do need to be careful. There are a lot of lenders out there that will say no out of pocket. That means they're rolling in the closing cost. When we specify a no closing cost refinance, in my world, that means if your closing costs are $5,000, we then in turn have a lender credit that covers that, or we specify exactly what that difference is. So you ask, why or how would we pay for those closing costs? And you get a credit. So essentially think of it as reverse points. Everyone knows and understands that if you pay points, you get a lower rate. Just like on a refinance, if you paid points, you'd get a lower rate. If you paid the closing costs, you would get a lower rate. If you take a higher rate, then the lender gives you a credit toward your closing cost. Many clients ask, well, why would a lender give me a credit for a higher interest rate? And it's just math. Their algorithms say that if we have a mortgage for 30 years, the value to Freddie, Fannie, or in the secondary market is X. Then lenders like me take that wholesale rate, take our fee out, and then whatever is above that fee is a credit to the consumer. That credit then goes toward your closing costs and prepaids. Is there closing cost on a no-cost refinance? Technically, there is. There are always closing costs. What we define a no-cost refinance to be is that you get a credit from the lender that covers the entire amount of your closing cost. If it doesn't, then we consider that to be a hybrid or a quasi no cost, and then we'll tell you exactly what your cost is so we can factor in what your recoup time may be. You do need to be very cognizant of lenders like Rocket and some others that will say a no cost is representative of a no out of pocket at closing refinance. If they say it's not no cash at closing or no out of pocket, that means they're rolling in all the closing costs into your principal and increasing your loan balance. So a true no cost should be that your balance does not increase, the costs are paid for, and the only cash outlay at closing would be the startup of your escrow account for your taxes, your insurance, and the interest to get you to the end of the month. I tell people 1 month's mortgage payment is the max, along with 8 months taxes and insurance. And then if all the costs are covered, you'll get your current escrow account back from your current lender, typically within 30 days, and you should be back to even, and you'll skip a payment at the end of the month that you close. So all of those are brought to the closing table, thereby within a 30-day cycle, on a true no cost, you should be back to even. If you elect to roll in those escrows or roll in a mortgage payment, you are essentially taking cash out of your loan if it's still a true no cost. But beware of the person that just wants you to not pay anything at closing. then you have to ask the question, what are you rolling in to my loan? Will taking a higher interest rate to cover my cost make me pay more over the life of the loan? And does refinancing make me pay more over time? So the answer is, let's say you've paid 5 years on a mortgage, and you go do a no-cost refi, and you're at 6%, and we lower you down to 5.5%. Okay, that 0.5% differential, as long as you're getting it at no cost, there's no way that the new loan is going to cost you more money than the old loan unless you choose to have it do that. And what I mean by that is you can do a couple things. You can invest the money you save, and then it's a calculation after 25 years, how much money you have left over to pay the last 5 years. You might be have a lump sum and pay it off. You could set up the new loan on a 25-year mortgage, so it pays off on the same time frame, but then you take that 0.5% money and you put it in your pocket, and you go out to eat once a month, or you pay down another bill. Third option, keep paying the 6% on the 5.5% loan, and your loan went from a 25-year down to potentially a 20-year. So keep in mind, it's what you do with the money. If you spend the money, go to McDonald's, have nothing to show for it, then 25 years later, you're going to say, oh, I shouldn't have done this, and I extended the life of my loan and I'm paying more interest. And then I have to remind you that you ate at McDonald's for 25 years for free, and you have to then back that out of that cost to figure out if you made money or did not. Okay, so be smart with the savings. Take every opportunity you can to refinance. And if you're super smart, you can pay your loan off much faster. What are the major advantages of a no-cost refinance program? One of them is that you essentially can chase the market down on your interest rate using the bank's money, so to speak. One could argue that you're paying the closing costs by taking a slightly higher rate, as we discussed in the previous slide. But here's the thing. If you were paying the closing costs to get a quarter lower rate, first thing that you would ask is, do you think the rates are going to go lower? My answer is, if you do your refinance at no cost, I don't care. As soon as the rates do go lower, I'm going to do another refinance. So it does not inhibit you from pulling the trigger when you're effectively not paying the cost and or rolling the cost into the principal. You're rolling it into the quasi interest rate that the lender thinks they're going to make more money over time. We're using the time value of money to our advantage. They think that they're going to make X dollars on it. We're going to get paid up front. We're going to cover those costs, and then we're going to notch ourselves down at the next opportunity. As I specified in the previous slide, how often can I do a no-cost refinance? There are typically clawbacks on lenders for up to 6 months. So the real answer is keep the loan that you have for 6 months or 180 days so that the lenders can continue to operate effectively on your behalf. The other part is technically you can probably secure your next refinance at the 4 or 5 month mark based upon 45 and 60-day locks potentially, but I would argue you'll get a lower rate if you wait till the 30 or the 150-day mark. Okay. When should you do a no-cost refinance? One, as soon as you're eligible. After your purchase, As long as it is with a different lender, you could in fact do it right away. But generally, waiting that 4 to 6 months is fairest so that the first lender doesn't have a clawback on their loan. After that, the rule of thumb should be anytime you can get a no-cost refi that saves you 1/4 to 3/8 in rate. I highly recommend going ahead and locking that in. You're locking it in for 30 years. I had an old adage, especially if it saved me $100 a month. If I knocked on your door at the beginning of every month and gave you a $100 bill, I'd probably become your friend. In many cases, it's more than $100 in our area. So, golden rule: hey, if you can notch yourself down every 1/4 to 3/8 at no cost or more, you should absolutely initiate the no cost refi. At the point that it's free, you don't have to sit there and say, oh, is it going to go lower? I don't care. I'll wait my 6 months and I'll take advantage of it and hopefully even get a lower rate. Are there prepayment penalties with a no cost refinance? There are no prepayment penalties whatsoever. We do ask typically that you at least keep the loan for 180 days because the lenders do have clawback periods on the mortgages. And that can get quite expensive. And in general, the lenders can look at how often you're doing the refinances and assess it from that aspect on whether or not you're in potential EPO risk, which is an early payoff risk. No one wants to know that they don't make money on a loan for up to 6 months, but that's kind of the nature of our business, and can cost a lot of money depending on the integrity of the consumer. When should I pay cost on a refinance versus doing a no cost? It's pretty simple. You should always do a no cost whenever possible. As long as the spread makes sense. So what I mean by the spread is the difference between a no point refinance and a no cost. The higher the rate or the more the spread, the less advantage a no cost might be. So what happens is once you get below about a $200,000 loan amount, the spread between the two are greater, so it might make sense to pay closing costs on smaller loans. Typically 200 and below is that mark. Question from a viewer: I want to take cash out. Am I better to do a no cost refinance or pay the closing cost? Here's the thing: cash outs take a hit. So you're going to end up taking a higher interest rate. So the reality of it is, I would say do the cash out at no cost. You're going to have to wait 6 months. Then after that, your loan is no longer a cash out, and then do another no cost at that point. So, and you hope that the interest rates, are in your favor. But since you have to take a higher rate and an additional hit for the cash out up front, you're probably absolutely going to be able to save money on the second one as long as the market stays the same or better. So rare do I ever have anyone pay closing cost. The one time to actually pay closing cost is typically if you really, really feel we're at historic lows and you think it's going to be the last refi you're going to do. That's when to pay the money. Client asked about recoup time. So the old rule back in the day was lower your interest rate 2% or recoup your closing cost in 2 years. The 2% rule was in conjunction with ARMs, and that rule made sense if you were going from an ARM to an ARM. And then the 2-year recoup time was typical if you were just refinancing and paying the cost and trying to figure out if it made sense. On a no cost, there is no recoup time. So it absolutely just makes sense. So if you are paying some cost or a hybrid, then you want to evaluate the recoup time. Generally speaking, in that instance, I like to see it at 6 to 9 months, kind of within that margin of that 180-day time frame, so that we're all on the same page of it making sense and getting you prepared for your next potential opportunity to refinance if the market continues to improve. Do I go backwards if I refinance my 30-year mortgage if you've already paid 5 years? This is one of my favorite questions and also a pet peeve at the same time. Okay, so clients in general have that stigma or thought that they pay interest at the first, at the very beginning of the loan more, and that you go backwards by adding another 5 years to the mortgage. The answer is that it could be true. And here's the instance, right? So you have to tell me what you did with the savings for 25 years and then evaluate what you did with that money in the 25th year, and then evaluate how much you owe in the last 5 years. So if you invested that money for 25 years, you might have a lump sum money just to pay off the last 5 years, and then the answer is that it's not true. Okay, you might elect to pay the full amount of your savings onto the new loan, and then you go from a 25 years down to maybe a 20 or less. So it's what you do with the savings. Now, a way to combat it and have your cake and eat it too is very simple. Set the loan up for 25 years and still take the savings. You can invest that money. You can put the rest of the money on the mortgage. You can do whatever you want to do. But then there's no argument on whether it made sense and whether or not you added time to your mortgage or not, because you didn't. What is the spread on a no-cost refinance versus a regular refinance? Depends on timing. When the market is in a purchase market like we have been, the lenders and the anticipation that rates are going to go lower, the lenders are not giving the typical spread on the above par pricing or the monies we would use to pay your no cost. That spread should be between 50 and 62 basis points for an eighth. So it should only cost about a quarter more to do a no cost in most cases, or 3/8. So rule is probably a quarter to 3/8 difference between the two. So if the rate that you can get for free is below what you have by a quarter or 3/8, you should just do a no cost. If you elect to pay the closing cost and get a quarter or 3/8 lower, and I'm giving that away 6 months later for free, you're going to kick yourself. What is a hybrid refinance? There are times in pricing when you buy up the interest rate, therefore your credit should increase, that it might not be increasing enough. Okay, let's say $1 million loan and closing costs, let's just hypothetically say, are $6,000. At 5.5, they're paying you $4,000 of the $6,000. At 5.625, an eighth higher rate, they're only paying you, let's say, $5,000. So that's only $1,000 additional credit toward your closing costs for taking a full eighth higher rate, which would cost you $1,250 in interest over the year. You're better off to take the lower rate and pay that extra grand in closing costs in that situation. So it's really about evaluating what they're paying me for the individual rate I'm choosing, evaluating the eighth above or the quarter above, and evaluating whether or not they're paying me enough money for it to make sense to go up the ladder. If not, it might make sense to do a partial payment of the cost yourself. But then you also have to look at the recoup time in conjunction with that. So there are times that if the lenders are not paying me enough money to go up the ladder, that I'll stay at the lowest level that still makes the most financial sense for my refinance. Are there any advantages in doing a no-cost refinance? There are a tremendous amount of advantages. One, there's no better way to refinance and chase the market down using the bank's money to pay your closing cost and lowering your interest rate, lowering your carry cost, and saving money. There are a lot of examples I can give you, builder deals where clients are forced to use their lender, take a higher rate. Refinance as fast as you can. If you have a 2-1 buy down, you should refinance as quickly as you can. That buy down money is sitting in an escrow account, sitting there just to pay the interest on your mortgage. But if you can get a lower rate and you can refinance, technically that money goes toward your principal balance and you get the money back. Especially if the builder or someone else paid for the 2-1 buy down, you should absolutely refinance that thing as quickly as you can. Each time that you refinance, you can chase the market down every quarter to 3/8 using the bank's money, not your money. If you pay for the closing costs, yes, you're going to get an eighth or a quarter, maybe 3/8 lower rate. But you're going to kick yourself if I'm giving that same rate away for free 6 months from now. So you have to worry about what rates are going to do and whether it's perfect timing if you're going to pay for it yourself. But if it's built into the interest rate and you're not paying for it and you're not rolling it into the loan, there's no reason not to pull the trigger and save the money. There is no better way than to refinance with no closing costs. In my 27-year career of being the owner of First Meridian Mortgage, I have paid over $2 billion of refinance and, loans and paid the closing cost. I have very few where the clients actually pay the closing cost. Okay, only on the smaller loans is it a consideration because the spread widens based on the actual cost. What are the rules on a VA IRRRL and Streamline? Veterans, please listen to this part of the video. Beware of lenders that will say, I will refinance you and you'll have no out-of-pocket, no cost at closing. That does not mean they're paying your closing costs. On a VA IRRRL, you're allowed to roll all of that into the loan, so you have to be aware of what your costs are, if they're giving you a credit toward those costs, and a credit toward your VA funding fee or not. You have to understand your closing cost, okay? You have closing cost, and you have your VA funding fee, and you have your escrows, okay? Now, in conjunction with that, when I do an IRRRL, I try to pay all the cost and the VA funding fee and have you bring your escrows to the closing table, if possible, if you have the cash flow. If you roll that into the loan, you are essentially taking cash out of your escrow. You'll get your escrow back from the current lender, typically within 30 days. You can always apply that as a principal payment, then you didn't take any cash out and you'll be back to where you should be. So the goal is to first try to get a credit that covers all the closing costs. Second goal, credit that also covers the VA funding fee. That would be a true no cost on a VA IRRRL. IRRRL stands for interest rate reduction loan. The criteria that you need to be eligible: 210 days from the date of the first payment on the loan. 6 payments have to have been made. 0.5% lower interest rate. Recoup time under 36 months. Okay. You had to have made your payments on time for at least the last 6 months. It's not a full credit pull. You can just do a mortgage bring down on the credit report and verify that your payments have been made on time. No income, no asset verifications, no appraisal, streamline, done within 3 weeks. Super simple. Just need copy of the deed or mortgage note when the original financing was done, a picture ID, a mortgage statement, insurance statement. It is that simple. But again, beware of people that will act like they're going to give you a lower rate and roll everything in. It's not the best choice. Okay, take what you can get at no cost. Then look for the next opportunity when the time arrives. Okay, chase the market down using the bank's money. Streamlines are super simple. You don't need to hit a home run out of the gate. Doubles and triples add up to more runs than one home run. Okay, that's my name's Kevin Retcher. I'm the owner of First Meridian Mortgage. If you